Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, Wall Street kicked off the shortened week with a robust rally, buoyed by rising consumer confidence and prospects of progress in U.S. European Union trade negotiations. The S&P 500 climbed 2.1% on Tuesday, marking a halt to a 4-day slide, while the Nasdaq composite rose by 2.5%. Gains were broad-based, with all 11 sectors of the benchmark index ending higher, led by consumer and technology stocks. Investor optimism was bolstered by a sharp rebound in U.S. consumer confidence, which had been eroded in recent months by fears of a potential trade war, or at least a protracted one. According to the conference board, consumer confidence surged 12.3 points to 98 in May, the largest monthly gain in 4 years and surpassing expectations. The index's gauge of consumer expectations for the next 6 months jumped by the most since 2011, reflecting brighter views on business conditions, employment prospects, and future income. Notably, the improvement was broad across demographics, with Republican respondents recording the strongest gains. Contributing to the upbeat mood was President Donald Trump's announcement that trade talks with the European Union were progressing in a, quote, positive direction, end quote. Trump agreed over the weekend to delay the threatened 50% tariffs on EU goods and extend negotiations until the 9th of July, following a call with European Commission President Ursula von der Leyen. Quote, the EU has called to quickly establish meeting dates with the US, end quote, Trump posted on Truth Social, adding, quote, I hope they will finally open up the European nations for trade with the United States, end quote. The market welcomed this development, with Europe's Stoxx 600 index rising 1.3% for the week, wiping out losses from Friday after Trump's initial tariff threats. Germany's DAX DAX index closed 0.8% higher, hitting a record high. Quote, everyone has become convinced that Trump's tariff talk is all sound, end quote, said the head of macro strategy at Academy Securities, adding, quote, there will be tariffs, but not the massive ones that would seriously damage the economy, end quote. It would appear, since many of these countries have agreed to enter negotiations with the US, that the White House's strategy, though very messy at the beginning, does seem to already be bearing fruit. Of course, it is still too early to say. Treasury yields also dropped as government bond prices rose. The US dollar strengthened against all major developed market currencies, with the dollar index rising 0.4%. While consumers grew more confident about business prospects, income, and the stock market, companies like Walmart have begun warning of potential price hikes as tariffs gradually seep into the economy. However, many retailers are also still absorbing higher costs for now, cushioning consumers from immediate impacts. Quote, the rebound in consumer sentiment is already visible before the May 12th US-China trade deal, but gained momentum afterwards, end quote, here referring to the so-called Geneva Truce between the two countries, and that was said by a senior economist at the conference board, adding, quote, financial markets seem ready to move past the trade fears, and these numbers suggest households may be doing the same, end quote. As global trade tensions ebb and consumer confidence improves, Wall Street is regaining its footing, at least for now. Indeed, European regulators are preparing to conduct their first comprehensive stress test to identify vulnerabilities in the financial system beyond the traditional banking sector. This move reflects growing concerns about the rapid expansion of less regulated entities such as hedge funds, private equity firms, pension funds, and insurers. The European initiative, modelled in part on a similar exercise conducted by the Bank of England last year, aims to examine how a potential market crisis might impact the wider financial system. The hope is to prevent a 2008 GFC-like financial crisis, or even worse. According to sources involved in the discussion, speaking to UK-based The Financial Times, officials from the EU's primary financial watchdogs are working on the details of this system-wide stress test, with a timeline for launch in 2026. Non-bank financial intermediaries, NBFIs, have become increasingly central to the European financial landscape since the 2008 financial crisis, as lending activity has shifted from traditional banks to alternative lenders. The European Central Bank reported that non-banks accounted for about a quarter of the Eurozone's 19 trillion euro stock at the end of 2023, highlighting the growing role of insurance, corporations and pension funds in credit provision. Concerns are mounting about the potential risks and opacity of these institutions, particularly their interconnectedness with the traditional banking system. Prominent episodes such as the 2020 bond market turmoil and the liquidity crunch among energy traders following Russia's invasion of Ukraine have underscored the vulnerabilities associated with NBFIs. Claudia Bach, chair of the ECB's Supervisory Board, recently emphasized the importance of addressing risks in the NBFI sector during a European Parliament hearing. European regulators, including the European Banking Authority, European Securities and Markets Authority, European Insurance and Occupational Pensions Authority, and ECB, the European Commission, and the European Systemic Risk Board, are coordinating on this initiative. It's a big deal. Some national authorities, including in France, have already initiated similar sector-specific stress tests. The EU's efforts will complement ongoing supervisory exercises for banks, insurance firms, and clearinghouses. However, the move is likely to provoke concern among non-bank financial players who may face tighter regulations in the future. European regulators are also addressing gaps in money market fund regulations, where standards currently lag behind those in the US and UK. The stress test marks a significant step towards understanding and mitigating systemic risks in Europe's evolving financial landscape before it's too late. Indeed, we are living in interesting times. If you want to be on top of the most up-to-date analysis on the leading financial and economic updates in this new uncertain world, make sure you're subscribed to Market Update, and you will be. If you're getting some value from today's episode as well, don't forget to hit the like button. And finally for today, Southeast Asian leaders have launched a significant push to deepen regional economic integration, approving an upgraded trade pact and a long-term vision for growth at a summit that began on Monday of this week. This marks their first high-level gathering since Washington imposed sweeping tariffs on the region in April. Central to the summit was the conclusion of negotiations on an enhanced ASEAN Trade in Goods Agreement, ATIGA, which is set to be signed in October. This updated deal aims to cut remaining tariffs, dismantle non-tariff barriers, and streamline trade access across ASEAN's 10 member countries. Malaysian Trade Minister Afrul Aziz called ATIGA the cornerstone of ASEAN's economic integration, aiming for a seamless flow of goods. Since the original agreement's inception in 2010, intra-ASEAN tariffs have fallen to under 1%. The revised pact introduces forward-looking provisions focusing on bolstering supply chain resilience and digitizing trade documentation to reduce customs-related obstacles. One of the major changes in ATIGA is the plan to lower thresholds for qualifying products under rules of origin, easing access to trade benefits. Kyohei Yabu of the Japan External Trade Organization noted that advancing customs digitization would help overcome long-standing procedural hurdles and cut intra-ASEAN trade costs. These moves come as Southeast Asia faces mounting economic pressure from new US tariffs ranging from 10% on Singapore to nearly 50% on Cambodia, amid geopolitical tensions. The region's export-driven economies, including Malaysia, Singapore and Thailand, are particularly vulnerable to the impact of these measures. Intra-ASEAN trade has remained stagnant at around 21% of total trade, far below the EU's 60% integration level. Meanwhile, China accounted for 20% of the region's $3.8 trillion trade volume in 2024, and the US made up 12%, highlighting the bloc's exposure to external markets. In response, leaders have adopted the Association of Southeast Asian Nations Community Vision 2045, a 20-year blueprint aimed at transforming ASEAN into the world's fourth largest economy. The vision emphasizes deepening intra-regional trade and investment, expanding manufacturing, and increasing the use of local currencies to enhance financial resilience. Malaysian Prime Minister Anwar Ibrahim acknowledged the challenges, saying, quote, "Geopolitical tensions, economic fragmentation, climate and technological disruption are testing the bonds between nations." End quote. Separately, leaders agreed to formally admit East Timor as the bloc's 11th member in October. This expansion marks the first new addition since Cambodia joined in 1999, signaling ASEAN's commitment to regional unity amid an increasingly complex global landscape. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you for another update on Friday.